I'd like to now welcome our next speaker, Kim Liu. Kim Liu is the Vice President and Chief Investment Officer of Carnegie Corporation of New York. Kim, welcome. Thank you so much.
Thanks, Alex.
Mark, thank you so much for doing this. Yeah, so good to see
All right.
you.
Good morning, everyone. I am your palate cleaner that is sort of transitioning you from the excitement of Vinny's presentation to the CIO panel where you'll get all the deep information. I was asked to share with you a little bit about how innovation and technology is impacting the way CIOs are thinking about managing portfolios and how we're doing things. And so bear with me while I take you on a winding road through my career. So I have been managing the portfolios of foundations for 25 years. I expected y'all to look a little surprised by that, but obviously not. I spent 13 years at the Ford Foundation and the past 12 years at Carnegie Corporation. The impact that technology and innovation has had on managing these portfolios have been profound, both for me personally and for these institutions. I began my career at the Ford Foundation specifically hired to manage the tech portfolio and to pick tech and insurance stocks. At the time, about a third of the Ford Foundation's portfolio was in an internally managed public equity portfolio, and I was a part of that group. When I began in 1994, there was very little to be done in the insurance sector, so I spent all of my time on technology. During the next 6.5 years, tech and communication sector soared and grew to be about 50% of the public market. And as you know, it crashed in 2000. And over the next 10 years, the tech sector bottomed at about 20% of the market. And now, once again, we're in the midst of a resurgence. And tech and communications is about 30% of the US market, and tech alone comprises about 30% of the MSCI EM index. So it is not just in the United States, it's throughout the world. And I honestly think that this masks the real impact of technology and on innovation in the markets, because there is not an industry or a sector or a geography that hasn't been influenced by emerging technology at this point. At Carnegie, we have guest speakers at each of our investment committee meetings. These speakers address long-term trends that we believe have the potential to be future investments for us or identify risk. Sometimes these discussions have to do with geographies. We've had one on India and China. Sometimes they have to do with sectors. We've done retail. We've done agriculture, healthcare. Other times it has to do with global trends such as cryptocurrency and blockchain, the future of work, or artificial intelligence. Technology sits at the heart of these topics, and each one of us has given us potential investment ideas and identified risk, and sometimes both. Clearly, we cannot ignore the impact of technology on these portfolios. For one, I think it explains a little bit of the underperformance that many of us have seen, particularly with respect to value underperforming growth. Technology is complex, it's hard to understand, which makes it impossible for investors to clearly assign value to these companies at times. And so it leads to higher multiples at times, sometimes lower. Further, some of these business models lend itself to really high multiples and high valuations, just think SaaS companies. Given that we, like many foundations and endowments, have a structural bias towards value, we've been fighting against the tide. At Ford, I transitioned from the public equities portfolio to the private equities group. Ford's private equity portfolio at the time was about 75% venture funds. Many of the board of the Ford Foundation had been titans of industry who had either observed or been a victim of hostile takeovers, and they thought that the buyout business was unsavory, and conversely thought that the venture business was appropriate for a foundation. It was about growth, it was about job creation, and about expanding the pie. Ford had been the first investor in some of the most successful venture funds in the world. 60% of Sequoia won. Also, first investors in Mayfield, Whitney, August, IVP, Benchmark, just to name a few of them. So over the next 6.5 years, from 2000 to 2007, I got to see some of these greats differentiate themselves by being self-reflective, continuing to invest when things were a little scary, being good partners and aligning themselves with their LPs, while others imploded under the weight of their prior success, which which was created because there was a lot of hubris at the time about how they had created value in the past, and they felt like they could continue to do the same thing, and it wasn't possible to continue to do the same thing and still do well. During these years, Ford began to diversify and increase their buyout exposure. And at this time, we started to see a lot of the buyout managers, a lot of tech buyout managers emerge. You saw Silver Lake happen during that time, and TPG and Francisco Partners. This was a novel concept at the time. There wasn't a lot of tech buyouts, and now you see tech buyouts even in generalist funds. They're not just in specialist funds. Many of these firms gestated when things were good, were born when things were bad or at the top of the market, and had to live through a really dark period in the market when tech was not a particularly great place to be. Just to put a window on just how bad it was during this period of time, let me tell you a little bit about Carnegie's portfolio. So Carnegie got its first CIO in 1999. And at the time, it was really hard to get access to a lot of the big venture managers. And so we had a portfolio that was made up of a lot of emerging managers and a few of the stalwarts that we could get access to. But as you can imagine, performance was not great during this period of time. And the investment committee was getting really frustrated with the venture portfolio. So about 3 years after I got there in 2010, I wrote a paper on why I thought that we should still be investing in venture. And at that point in the cycle, our 10-year return in our venture portfolio was -1%. So a 10-year return of -1%. Our 15-year return was a 40% annualized return. So my argument was the bad years was an option that we had to pay to get access to the good years, because that was the nature of venture. They didn't buy it. As you might imagine, investment committees can tend to be sort of very focused on the here and the now and not be able to see that. Over drinks, I'll be happy to share with you what one investment committee member said about me at the time, but not for this audience at this time, but suffice to say he did not think it was an intelligent or well thought out strategy. But investments that were made during this period of time between 2005 and now, are the seeds that were planted for really good, strong performance. If you look at our current 10-year performance, we've had about a 16% return in our venture portfolio. We would not have been able to maintain purchasing power net of spending had it not been for our investments in these markets at the time when the committee did not want us to invest. So, this speaks to the fact that sometimes you have to be brave about investing in things when it doesn't look like a smart decision to do it. Just on a side note, similarly, our buyout portfolio also performed this strongly during that period of time, and it's also because of a lot of success in our tech portfolio. One dynamic of particular note that has changed over the past 10 years, and Benny talked about it just recently, is the blurring of lines between the public and the private markets, with companies staying private for longer, and that changing the nature of these asset classes and making CIOs have to think differently. And it does not go without note that them staying longer in the private markets means it is more costly for us to own them, because the fees in the private market are much higher than the fees in the public market. Clearly, tech and communications have produced strong returns in both public and private markets, but innovation has also altered the shape of the markets. Without questions, advances in technology and communications made possible for high-speed trading and to some extent passive investing. These trends change not just the valuations, but actually how the market works. And we've got to pay attention to that, and we've got to incorporate that into our thinking. As Warren Buffett said, it's still wisely, be fearful when others are greedy and greedy when others are fearful. And this is, of course, easier said than done, because you're not sure whether you're being smart when you're being a contrarian, or whether it's a dumb thing to do. But before we talk about where we are in this cycle, I will leave that to the CIOs that come after to talk about it. But I wanted to spend a little time talking about how technology has impacted some of our other asset classes. Real estate. We've traditionally thought of it as a diversifier against equity risk, but technology is also altering it and providing different opportunities. In commercial real estate, we're seeing customers demand greater access to technology. It's no longer a luxury, it's a necessity. Retail has been severely challenged by e-commerce, and increasingly survival is dependent on the ability to provide access to tech and allow the retailer to meet the special needs of the new consumer. Store footprints are shrinking, experience spaces are getting bigger, as are logistics spaces. The way we use space will be altered by things like electronic cars and autonomous vehicles. We're going to need a lot less parking spaces and a lot more charging stations. Cities are densifying, and the real estate demands are just changing profoundly, and all of this has to do with technology. Similarly, if you look at resources, there's just greater demand for limited resources that require us to be dependent on other geographies. Lithium. All of this is made possible because of lithium, and we don't have that in the United States. The technology has made it easier for us to extract oil and gas out of the ground, but it's also exacerbated climate issues. So we're seeing renewables become an increasing part of people's portfolio. We're in the process of doing a food study at Carnegie, which has led us through the food chain. Ag tech wasn't even a focus area for us 5 years ago, and now there are a ton of conferences about it, including the Equilibrium Conference, which is happening here in San Francisco right now. Planting, harvesting, tracing, producing, and distributing food have all been changed by technology. This brings me back to my original statement that it's hard to find an industry that has not been changed by technology and innovation. But as I said, the issue is not just asset classes and sectors, it's also geographies. Technology has erased barriers that have traditionally separated countries. It makes it possible for markets to be global and for information to flow freely, but it has made us interdependent. I think it can, and I think it should be argued that the tariffs that we're imposing are fighting last year's wars. And really, the challenge is going to be around technology. It's going to be around artificial intelligence. It's going to be around 5G. It's going to be around CRISPR. So back to Warren Buffett and his call for contrarian investing. We need to ask ourselves, is the market being greedy? Is now the point where prudent investors should be fearful? Or has all the technology and innovation extended the cycle so much that there's still more to go? Are the lines between asset classes so blurred and the mix so lopsided that our expectations that we will see a reversion to the mean flawed? Has the size of passive flows grown so large that they have swamped fundamental valuations? These are all questions that make us rethink our traditional signals. But we also know that it's the foremost dangerous word for any investor to utter is, this time is different. The fourth quarter of 2018 was the first sign of market jitters, but the recovery in the first quarter of 2019 was swift. Given the relative strength of the US economy and the instability in other markets, it's not clear that we can expect the US to decline in the near term. But I suspect that when it turns, it will be fast. And between now and then, things will be very volatile. So now that I have identified some of the problems, I will leave it to the peers on the next panel to come up with the solutions, while I sit in the audience and take notes. The panel is titled Late Market Cycle Portfolio Management. Please allow me to introduce the host of the panel, Sue Slocum, the Chief Investment Officer of Children's Hospital and Clinics of Minnesota. She will help tease out the answers from these highly experienced CIOs.